After the 2008 financial crisis, Wall Street was forced to take a hard look at all the ghosts hiding in its machine. And one of the most dangerous, one of the most invisible of them all? Liquidity risk. Today, we're going to break down a really innovative framework that was developed inside JP Morgan to tame this exact threat. Okay, let's dive right in.
Wow, that quote really says it all, doesn't it? This isn't just about losing a bit of money on a bad trade. No, this is about the fundamental ability to even operate. When liquidity just vanishes, the entire system can grind to a halt, turning what might have been a small problem into a total catastrophe. The stakes just couldn't be higher.
So what is liquidity risk, really? Well, to put it simply, it's the danger that you can't sell something when you absolutely need to, at least not without taking a huge loss on the price. It's not about whether your asset is valuable, it's about how fast you can turn that value into actual cash.
All right, so the need for a totally new way of thinking became incredibly urgent over at JP Morgan Private Bank. See, they weren't just dealing with some abstract theoretical problem. They were managing a real-world portfolio of just staggering size and complexity.
And here is the scale of that challenge: $500 billion. That's a portfolio so massive that even a tiny, miscalculated risk could snowball into absolutely monumental losses. You can just imagine the weight of responsibility on that team.
And here's what's really interesting. The problem wasn't just the sheer amount of money, it was the diversity. We're talking about 17 different kinds of assets, everything from super liquid government bonds and currencies to things on the other end of the spectrum, like private equity and direct real estate, which are famously illiquid. And each one of those behaves completely differently, especially when the market is under stress.
Which, brings us right to the heart of the matter. The traditional models, they had completely failed. So how on earth do you create a system to manage a risk that's basically invisible, a risk that moves incredibly fast across such a huge and varied landscape?
Well, the answer came from a pioneering new approach. A team at JP Morgan's world headquarters, led by Chief Scientist Dr. Yogesh Malhotra, developed this very framework. And it was a complete, top-to-bottom rethinking of how you even see, let alone measure, liquidity.
The framework itself is built on a really simple but powerful layered idea. So first, you look at the liquidity of every single asset class on its own. Then you group them together into bigger buckets, like different funds, and you see how they all interact. And then finally, you roll it all the way up to get one single holistic view of the entire portfolio's risk. It's genius, really. It builds the whole picture from the ground up.
So the crucial point here is that this was about so much more than just a new formula. It was about creating a system that was truly resilient, one that was forward-looking. The goal was to minimize what they call model risk, the danger that your own models are wrong, and to build something tough enough to withstand the next crisis, not just refight the last one.
Okay, so how did they actually do it? This is where the innovation just really shines. How in the world do you put a number on something as slippery and as hardest to define as liquidity?
All right, let's start with a really simple analogy. A liquid asset, say a popular stock like Apple, has a price that's updating constantly, right? But an illiquid asset, like a piece of real estate or a stake in a private company, well, its price is sticky or stale. It doesn't change very often, and the value you see on paper can be a lot smoother than what it's really worth.
The statistical tool they use to measure that stickiness is called serial correlation. Now, what it does, in essence, is measure how much an asset's price today is connected to its price yesterday. For those illiquid assets with stale prices, that connection, that correlation, is really high. And this, right here, is the core insight. They realized that serial correlation could be used as a stand-in, a proxy for liquidity. Absolutely brilliant.
And once you have that tool, you can start to rank different assets on a relative scale. So, for example, currencies have almost zero serial correlation. They're incredibly liquid. But then you look at something like private equity or direct real estate, and they show a much higher correlation, which signals a much higher liquidity risk. Suddenly, you can actually quantify the unquantifiable.
So, what was the real-world impact of this new way of thinking? Well, it didn't just stay inside JP Morgan. These pioneering ideas were later presented at Princeton University's super prestigious quant finance conferences, and they ended up influencing risk management all across Wall Street.
Ultimately, this framework represents a true paradigm shift. It moves away from those flawed single measures and towards a complete, holistic view. It explicitly accounts for those rare catastrophic events, what they call the fat tails.
It bakes stress testing right into the process. And importantly, it even tries to figure out the cost of liquidity insurance you might need to protect the portfolio. It's a truly comprehensive approach.
And we're going to end on this vital piece of wisdom. Because no matter how sophisticated our tools get, the challenge of managing risk is never, ever truly solved. This framework was a giant leap forward in seeing the invisible for sure. But it's also a powerful reminder that the ultimate goal isn't to perfectly predict the future, but to build systems that are resilient enough to survive it.